Let's talk about how we want to define the term. It's being discussed a lot now. Climate solutions, climate impact investing, green investing. Some of the terms are tighter, some are looser. But let's try and discuss how we in our individual firms see them and what we think of when we talk about them. Benji?
Sure. Okay, so I'll be speaking from the fixed income perspective, in that from our perspective, if your goal is to outperform the Barclays aggregate or some broad-based goal or broad-based benchmark, that at this point, if you really truly want to have a diversified portfolio, you're not going to be able to just have a portfolio of just green bonds or just positive impact bonds. And that's just not the reality of the situation if you want to have something that's, again, broad-based, diversified. At this point, the vast majority of the investments that are available in the green bond space are in the supranational sovereign foreign agency, what they call the SSA space. That's where most of the investing has come from. I mean, there's some obviously on the muni side too, and that's a pretty decent sized portion. On the corporate side, and I'm talking the U.S. dollar also. On the corporate side, there's really only been a few corporate green bonds that have even come out in the first place. And so, when you think about having a diversified portfolio, and that you'd likely want to have at least 100 corporate names, and there's 4 or 5, 6 or 7 if you include some of the high yield deals that are out there, obviously you can't have true diversification at this point. We don't invest in treasuries because of the peace church stance that we've taken. But you're going to want to have some agencies or agency mortgage-backed securities, and you could do some affordable housing deals and some of those types of things. But truly, to have a broad-based, diversified portfolio, at this point, we feel like about 17% is how much you can have in a portfolio, based upon our experience of what we think we can be able to do. So when we think about it, and at this point, we've sold the exposure that we have to coal. We've sold some of the exposure that we have to some of the other oil-based companies. Because about a year and a half ago, we went through a new screening process where we utilized MSCI's ESG research. So in the past, we had an environmental screen, but much of that was based upon who had an oil spill at some point in the future, or who did something bad that someone was going to get upset at us. Not that it wasn't a screen, it was an appropriate screen at that point, but because of new data that's been coming out, we were able to take MSCI's work, specifically on the E side, for the environmental side, and look to see who's the worst carbon emitters. So we wanted to screen out kind of the worst of the worst there and not even have them available to invest. Who have some of the worst environmental scores, and so that's more about management systems and things like that. So by doing that, then we've actually not even made available some of the worst carbon emitters. So by doing that, we generally have a lower carbon portfolio. So at this point of the underground 200, I think we have about 75 basis points of the entire portfolio in there, and we've tried to grab some of the companies that have higher environmental scores in the first place. So to really have this kind of low carbon or green diversified portfolio, what's necessary, I think, is to do a balance where you're going to have a very small or minimal portion of some of the strongest names that are out there in the environmental side, but then also try to do some positive bonds. Try to do something where you can actually make a difference, whether that's in some of the labeled green bonds, which have been talked about multiple times, or whether that's actually in solar or wind farms or different projects where you really legitimately can have an impact by us, along with others, actually lowering the cost of funds for some of these guys. So, a low carbon or green portfolio, in my mind, that's kind of what would make that up.
Terrific, thanks. Val, can you talk about this from a Citigroup perspective more broadly than the work that you just see personally?
Sure. So I suppose I'm a little bit of the odd man or odd woman out here because unlike my colleagues, Citigroup finances the global economy, so we finance it all. And one of my team's jobs, as ICCR knows, is to help to figure out creative ways to incentivize more of the environmental solutions, low carbon finance, while working very closely with our teams from risk and engaging directly with clients to help to manage the environmental and social risks that may come along with the financing of some traditional sectors. So we are a big energy bank. We are also a really big renewable energy bank. So it's been interesting as we've sort of looked at how Citi's environmental performance has changed over the last 10 years, because I really felt like a decade ago was where this shift started to happen, certainly in the way that banks looked at first environmental and social risk from an equator principle standpoint, but also at how to stimulate and incentivize and work with more clients on more renewable energy deals. I feel like we have begun to see a shift. We have seen a shift, first of all, in how much we're able to engage with our clients on some of the environmental and social risks associated with some industries. We've also seen a shift in how different industries themselves are transitioning. We did an analysis a couple of years ago focusing on the U.S. power sector and our clients in the U.S. power sector, and we used data that Ceres provides, and looked at the trends of carbon intensity. And we found two things that weren't really a surprise to our energy bankers, but it was nice to sort of see the trend on paper. One is that the U.S. power sector and our energy generation here in the United States is generally going on a less carbon intensive trend. So we're seeing a nice general drop in how much carbon is being generated as we produce power. The other thing we saw, and this is more sort of anecdotally, is that some of the big carbon intensive clients of ours, the biggest producers of coal-fired power, were also the biggest producers of renewable energy. So they were just big power producers. So, you know, I think as we look at a diversified portfolio, it really looks like our clients looking at how they transition and look at a diversified portfolio. I don't want to overstate where we are, but I think there's a lot of room for optimism in what some of our clients have been able to achieve even without regulatory pressure.
Thanks, Val. Terrific. Matt?
Great, thank you. Boston Common has a holistic approach to climate finance. We certainly invest in what we think are environmental solutions. Most obviously would be the renewable energy type of industry, but we've found more what we think are exciting, larger opportunities in industrial technology space, which have energy efficiency applications to it. In addition, we look at all the companies that we invest in terms of how they operate internally and really want to push them to improve upon their energy efficiency internally, whether it's the full life cycle of production of a manufacturing product or a services company like a bank, where we've been actively engaging to push banks to consider climate change as a risk factor in their underwriting. In addition to that, we would be looking for ways to participate in what the solutions are over the long term in terms of the growth areas on a global basis. We would echo some of what Benji said with regard to diversification and risk reward of what tend to be smaller companies, less liquid in the pure solutions area. But in addition, we've also developed a sustainable climate solution, which is fossil fuel free, where we've been doing this for certain clients for 6 or 7 years with a pretty good record in line with our own model portfolios, as well as this past year in a fund, specific fund application, which has done quite well in the face of collapsing oil prices. So it's a really three-pronged approach: investing in pure play solutions companies, investing in all of our companies that we think are really trying to do the right thing in terms of their environmental performance across the board, internally and externally. And third would be in terms of our adequacy to engage in terms of with the companies that we invest in to improve upon their overall environmental performance.